Turn on financial news and the headlines feel relentless. AI revolutions reshaping industries, geopolitical tensions redrawing supply chains, interest rate uncertainty clouding forecasts, energy constraints limiting expansion, market volatility reacting to every data release. From the outside, it looks like constant motion. But step inside many boardrooms in 2026, and the mood feels very different. Measured, controlled, even calm. The strange calm inside corporate America is not the absence of risk. It is the result of intentional design. After years of turbulence, companies have restructured themselves to absorb shocks rather than react emotionally to them. Over the past several years, executives have navigated some of the most unpredictable conditions in recent memory. Demand surged and collapsed in unexpected cycles. Supply chains broke down. Labor markets tightened. Inflation spiked. Interest rates rose at the fastest pace in decades. Those events forced adaptation. Cost structures were adjusted. Vendor networks were diversified. Liquidity buffers were strengthened. Forecasting models were stress-tested. Contingency planning became standard practice rather than an afterthought. After surviving repeated volatility, corporations did not simply return to old playbooks. They redesigned themselves around resilience. That redesign explains much of the calm. The strange calm inside corporate America reflects stronger balance sheets. Many large companies are holding higher cash reserves than in previous growth cycles. Debt maturities are spread out more strategically. Leverage is being managed carefully. Liquidity is no longer treated as idle capital. It is viewed as strategic infrastructure. When executives know they have financial flexibility, urgency softens. Decisions become deliberate rather than reactive. Short-term market swings carry less emotional weight. Another key reason behind the strange calm inside corporate America is the shift in investor expectations. In earlier expansion cycles, markets rewarded explosive growth. Companies were pressured to outpace competitors quarter after quarter. Missing targets could trigger sharp valuation declines. Today, investor priorities look different. Stability is rewarded. Predictable earnings are valued. Margin protection carries weight. Disciplined capital allocation is praised. When markets reward consistency over spectacle, executive behavior adjusts. Earnings calls emphasize efficiency, operational focus, and long-term sustainability rather than hypergrowth. Artificial intelligence provides an interesting contrast. Public narratives around AI feel urgent and transformative. Headlines describe paradigm shifts and massive infrastructure spending. Yet inside corporations, AI deployment is often phased and methodical. Pilot programs are launched before full rollouts. Infrastructure expansion is staged rather than rushed. Returns on AI investments are measured carefully. Risk committees review implementation plans. Rather than chasing headlines, companies are integrating AI into workflows cautiously. That discipline contributes directly to the calm. Is this calm complacency? In most cases, no. The strange calm inside corporate America is built on caution, not indifference. Hiring is more controlled. Capital expenditures are scrutinized through stricter approval processes. Supply chains are diversified across regions. Energy strategies are negotiated years in advance. Companies are not ignoring volatility. They are engineering insulation from it. Industry maturity also plays a role. Many major sectors, cloud computing, e-commerce, digital advertising, enterprise software, have reached more stable phases. Penetration rates are high. Growth continues, but it is incremental rather than explosive. In mature industries, operational excellence matters more than dramatic expansion. Execution replaces experimentation as the core competitive advantage. Mature industries tend to operate with steady rhythms rather than dramatic surges. That steadiness reinforces the calm. Liquidity adds a psychological layer. When companies maintain strong cash positions, they feel less pressure to respond aggressively to every macro headline. They can absorb temporary slowdowns without immediate restructuring or emergency borrowing. Financial buffer creates composure, experience strengthens it further. Leadership teams have now navigated multiple shocks. They have managed through extreme supply disruptions, rate hikes, labor tightness, and rapid demand shifts. Institutional memory shapes decision-making. When executives have already faced instability, new challenges feel manageable. Preparedness reduces panic. The strange calm inside corporate America is also visible in capital allocation strategy. Instead of expanding into every adjacent opportunity, companies are narrowing focus. Core businesses receive priority funding. Peripheral ventures are evaluated more critically. Selective growth has replaced expansion for expansion's sake. This does not mean competition has disappeared. Markets remain intense. Technological change continues. Startups still emerge. But the tone has shifted from aggressive land grabs to disciplined positioning. Companies are choosing durability over dramatic expansion. In some cases, the calm reflects strategic patience. Executives are waiting for clearer economic signals before committing to major new investments. They are pacing expansion to match confirmed demand rather than projected optimism. Patience can look like silence. It can look like inaction. But in many cases, it is calculated timing. There is tension embedded in this calm, however. Moving too cautiously could create missed opportunities. If competitors act more boldly in AI, energy infrastructure, or advanced manufacturing, overly defensive strategies could limit long-term growth. The calm is steady, but it is not passive, it is watchful. Is corporate America comfortable? In many ways, yes, more comfortable than during periods of acute disruption. But comfort does not equal complacency. It reflects redesigned operating models built specifically for uncertainty. Strong liquidity, controlled hiring, phased capital spending, measured guidance, diversified supply chains. These are not signs of retreat, they are signs of structural adaptation. The strange calm inside corporate America signals that executives are no longer reacting impulsively to every market swing. They are building systems designed to withstand volatility rather than chase momentum. In 2026, resilience has become the new form of growth. The outside world still feels noisy. Markets fluctuate daily. Headlines amplify risk. But inside many corporations, the approach is structured, calculated, and steady. The calm is not accidental, it is engineered.